The median paycheck in America sits at around $5,000 a month. Generating that exact amount purely from index fund dividends without ever having to sell off your principal is the actual goal of passive income. When most people attempt to build this, they instinctively turn to the most popular vehicle in the market, the S&P 500. But the S&P 500 is engineered for broad growth, not cash distribution. To collect $5,000 a month from its current yield right now, you would need a starting balance of $5.7 million. Since the average American retires with about $192,000, the math fails immediately. This mathematical barrier pushes many investors toward the opposite extreme. They hunt for specialized high-yield stocks that boast 7, 9, or even 12% payouts, hoping to hit their target with less cash. Those astronomical yields are almost always a trap. In the market, a massive yield usually indicates a falling share price and an impending dividend cut. You receive a large monthly check for a brief period, while your underlying principal is actively being destroyed. A sustainable paycheck requires a structural balance known as the total return blend. This relies on three specific elements working together: a reliable starting yield today, consistent dividend growth every year, and steady capital appreciation. As this matrix shows, comparing these approaches directly highlights the gap. Standard growth funds require capital most people will never reach, while chasing double-digit yields exposes principal to severe loss. The total return blend sits in the middle, balancing realistic capital requirements with principal protection. Hitting that $5,000 monthly target requires stepping away from generic index funds. You have to build a highly specific portfolio of specialized assets that most investors ignore. This strategy relies on 5 distinct Vanguard index funds. Every single fund is assigned a strictly defined, non-overlapping job. The foundation is the Vanguard Dividend Appreciation Index Fund, or VDAX. It offers a low starting yield of 1.49%, but enforces a strict filter, holding only companies that have increased dividend payouts annually for a decade. That requirement filters out market fads, leaving behind mature consumer companies with deep cash reserves. It captures legacy tech monopolies that have successfully transitioned from rapid expansion into reliable cash distribution, and it secures the established manufacturing giants that provide total portfolio stability. This scorecard breaks down the specific outcome. VDAX has grown its dividend at 8.46% annually over the last decade. While initial momentum is slow, that growth mathematically doubles your income every 8 to 9 years. The second key asset is the Vanguard Energy Index Fund, or VENAX. Energy is currently an out-of-favor sector, which is exactly why it secures a significantly higher starting yield of 2.48%. The strategic trade-off here is patience. You secure current income while waiting for the broader market to eventually rotate back to energy, accepting slower share price appreciation. The third component moves the strategy overseas. The Vanguard Total International Stock Index Fund, or VTIAX, casts a wide net over 8,000 non-US companies. Looking at its track record, VTIAX delivers dividend growth of 12.23%, significantly faster than domestic options. The cost of that speed is absorbing the geopolitical volatility that causes Wall Street to often avoid these markets. The fourth fund, the Vanguard International High Dividend Yield Index Fund, isolates the top half of global dividend payers. VIAX secures the portfolio's highest immediate starting yield at 3.24%, deliberately excluding the fastest-growing companies to get it. The final piece, the Vanguard International Dividend Appreciation Index Fund, does the exact opposite. It focuses solely on international companies with 7 consecutive years of dividend growth. VIAX provides the fastest dividend growth at 13.32% annually, ensuring the portfolio captures future acceleration. Blending these 5 funds is a straightforward structural process. You allocate exactly 20% of your capital to each of the distinct funds. This equal weight creates a combined portfolio that yields 2.43%, grows its dividend at 11.05% annually, and depreciates at roughly 6.99%. The ultimate trade-off for this stability isn't a secret formula. It's the psychological discipline required to rebalance annually and ignore short-term market fads. With the exact funds selected, the focus shifts to the 2 physical resources required to drive them: your out-of-pocket capital and your timeline. The 30-year plan is built for budget-conscious investors who are rich in time. It requires a starting balance of $10,000 and a daily contribution of $7. Looking at this 30-year compounding curve, those accessible inputs reach the $5,000 monthly target, requiring only $86,650 in out-of-pocket contributions. The brutal trade-off is a decade-long dead zone. For 10 years, compounding feels invisible, and progress appears non-existent. The 20-year plan is for capital-heavy optimizers. It demands an aggressive $70,000 starting balance and $35 daily. That massive upfront weight alters the trajectory, successfully shaving a full decade off the timeline to reach the exact same milestone. This quadrant chart reveals the humbling truth of the strategy. Shaving 10 years off your timeline costs $325,500 out of pocket. You are paying nearly 4 times more cash just to compress the clock. Sustainable dividend investing is never a get-rich-quick scheme. It is a strict mathematical transaction where you trade present capital for future time. You have to honestly assess your budget, pick your timeline, and accept the cost.